Okay, so the next current liability we'll cover is dividends payable. Dividends payable occurs or arises when a company declares that it's going to pay dividends. Since dividends will generally be paid in less than a year from the declaration date, they're classified as current liabilities. Okay, so whenever we deal with dividends, there's always going to be three dates. First date's a declaration date. On the declaration date, the company is essentially promising that it'll pay dividends, right? It's declaring dividends. And since we're declaring that we're going to pay dividends, we've now created an obligation for ourselves. Right, so whenever this happens, debit or credit dividends payable for the amount, and you'll debit dividends. So let me just put that out to the right. The second date you'll deal with is the record date. So on the record date, the company determines who its stockholders are, so it knows who to send the dividends to. Okay, so since on this date, all we're determining is who the stockholders are, assets, liabilities, and equity aren't going to change. And so because those don't change, there will not be any journal entry on this date. Okay, and then the very final date is just the payment date, where we're actually going to pay the dividend. So since we're paying the dividend on this date, we can remove the prior liability that we incurred for this. So we'll debit dividends payable. Right, and generally when we pay the dividends, we'll be paying out in cash, so you'll credit cash. Okay, so we'll just put a no entry for record date. Right, so these are your three dates and the general journal entries you'll make on each date. Okay, next liability is a customer advance and deposit. These are just returnable cash deposits that a company receives from its customers or employees to guarantee performance or payment. For example, if you ever rented an apartment or a house before, you probably had to pay a security deposit. Right? The security deposit guarantees payment to the landlord in case while you're renting, you damage some of the property. However, if you don't damage the property, the security deposit gets paid back to you as the renter. All right, so in general, customer advance and deposit, we're really just talking about something like a security deposit. Right? And then depending on the date of the deposit and when the relationship ends, your advance or deposit will be classified as current or long-term. Right, so generally, when we receive a customer advance deposit, right, we'll just debit cash because they're paying us cash in advance for something, and generally your credit will just be to customer advances. We won't deal too much with customer advances and deposits in this class since it's pretty straightforward to account for it. But here's your basic journal entry for our recognition. The next current liability we cover is unearned revenues. So unearned revenues you should again be familiar with from Principles of Accounting and Accounting 301A. For these, there's two general journal entries you'll make. First is when you recognize it. So let's just say, for example, receive say $500 or $5,000 in advance for, let's just say, future rent revenue. Right, when we receive this money in advance for rent, you would debit cash, right, because we got cash. And in this case, you cannot credit rent revenue because we haven't yet earn the revenue. In other words, we haven't yet provided the product or the service. So in this case, it is unearned. So you'll credit unearned revenue for $5,000, and as you already know, unearned revenue is a liability. Now, over time, as we start to perform the service or we provide the product, we can start to recognize revenue. All right, so let's just say in the past example, pay $5,000 in advance for 10 months rent. All right, so each month of rent then is costing us $5,000 divided by the 10 months. So that gets us to $500 a month. All right, so let's just say 3 months pass, and we're going to create journal or adjusting entries. All right, that means we've now earned, if 3 months have passed, we've now earned 3 months of rent. So $500 per month times 3 months equals $1,500. All right, so after 3 months pass, we can now reduce our unearned rent revenue by the amount that we've earned, and then we'll recognize that amount as revenue. So pretty much you'll recognize it, and then over time, you're going to recognize unearned revenue as earned. And these are your two basic journal entries here. The next current liability we'll go over is sales tax payable. Right, so from the perspective of a retailer, every time they sell something, they need to collect sales tax. Right. However, the whole point of collecting sales tax at the time of sale is that eventually they're going to take the taxes and they're going to send them over to the government. So from the retailer standpoint, even though we're getting cash for sales taxes, it's a payable because ultimately that we're obligated to give that sales tax to the government. So to record sales tax, there's two different methods we could use. The first is to record sales tax with every sale. As you might imagine, for many companies, you're dealing with thousands, tens of thousands, or even hundreds of thousands of transactions or sales transactions every period. So if you recorded sales tax along with each sale, generally it just becomes kind of impractical. It's not necessary to do that with every single sale. Right, so the more common method is to record a sales tax to actually first record our sales tax and recognize it as sales revenue, and then at the end of the period, we actually make an adjusting entry to take our sales tax out of our sales revenue and then finally recognize the payable. I realize that's probably kind of confusing what I just said, so let's just go through an example, which will be easier to see what's going on. Okay, so let's prepare the entry to record sales tax. We'll assume there was a sale of $10,000 and the sales tax rate is 5%. Okay, so again, method one was recording sales tax along with each sale. I know on the slide it has the journal entry all in one. I'm just going to create the journal entry in two entries because it makes it a little bit easier to see what's going on. All right, so in this case, our sale was for $10,000. So just like any sale, you could debit cash, assuming we got it in cash, and we'll credit sales revenue for that $10,000. Right, the second part of this is, well, we want to record the sales tax. Well, the sales tax rate is 5%. So 5% of $10,000 is $500. Right, at the time of sale, the customer would have paid us the cash for the sales tax. So we'll debit cash for $500. And then again, since we don't get to keep this cash, we have to remit these taxes to the government. We'll credit sales tax payable for $500. Okay, so notice here, this journal entry is really the same thing on the slide. Right, I've done it in two journal entries. But we could really just do this in one, where the total amount of cash we're getting is 10,500. Of this 10,500, 10,000 reflects sales revenue, and the other $500 reflects our sales tax payable. Okay, so that's method one. Again, method two, let me just put this out to the side so it's not as confusing. Method two, instead of recording sales tax along with each sale, essentially what we're doing is we record sales tax in sales first, and then at the end of the period, we'll make an adjusting entry. And in this adjusting entry, we're going to remove sales tax from sales revenue. Okay, so to see how this works, again, we're making a sale of 10,000. Sales tax rate is 1.05. So in total from the sale, as we saw above, we're getting the purchase price of $10,000. And we're also getting the sales tax of $500, which is just the 10,000 times the 5%. All right, so in total, we're getting 10,500. So if we're using method two, we'll just recognize the full $10,500 as sales revenue. So we'll debit cash for 10,500. We're recognizing the sales revenue. Okay. At the end of the period, we can then take out our sales tax from this total sales revenue of 10,500, because as we know, 5% of that, 5% of our sales are actually just tax. Okay, so to figure out the amount of sales at the end of the period, right, net of any taxes. Right, we can just take our total amount and we'll divide that by 1 plus your tax rate. Okay, so in this case, our total amount of sales, including tax, is 10,500. Our tax rate is 5%, so we'll divide this all by 1 plus the tax rate of 5%. In decimal form, it'll be 0.105. Alright, so 10,500 divided by 1.05 just gets us to $10,000. Alright, so this is our amount of sales. So if we take our total amount and subtract out the amount of sales, we have the total amount of sales tax. Okay. Since we want to remove the amount of sales tax from the sales revenue account, we'll debit sales revenue for the amount of sales tax we're trying to remove. And this $500 really just represents sales tax payable, so we'll credit sales tax payable for $500. So the next current liability is income tax payable. So for income taxes payable, we're really going to devote a whole chapter for this in chapter 19. So for now, I just want you to get the basic concepts down, which will make it easier for you to grasp income taxes when we cover it in chapter 19. Okay, so income tax payable, right, is just the taxes we're going to have to remit to the IRS in the near future. Right? It'll generally be from our past year of transactions. Right, so this is the amount that will be paid to the IRS. Right, so when we deal with income taxes, the income tax expense on the financial statements, right, this generally won't be the same as the amount of income taxes we have to pay to the IRS. right? And the reason why is income tax expense on the financial statements. Right, we've calculated income using GAAP. Right. So think about GAAP. GAAP is just some set of rules. The income taxes we pay to the IRS, or our income tax payable, right? This is based on income using tax laws, right? So in other words, what constitutes income under tax law isn't going to be the same as what constitutes income under GAAP. Right? Tax laws have a completely different purpose than GAAP, so we end up with these two different sets of rules. All right, so the big idea here is if we're using two different sets of rules, we end up with two different income numbers, which means our income tax payable and our income tax expense generally won't equal one another. All right, so we're going to learn how to deal with these differences in Chapter 19. But for now, what I want you to take from this is income tax payable is based on tax laws. It's how much we need to give to the IRS, and this generally won't be equal to our income tax expense on our financial statements. All right, again, we'll come back to this later. Just get the big picture for now. Okay, so moving on to employee-related liabilities. So employee-related liabilities just really deals with how we pay our employees. As you already have encountered before, right, salaries and wages payable is reported as a current liability. Just means our employees have done work for us, but we haven't yet paid them. However, this isn't the only current liability related to compensating our employees. Right? Other current liabilities include payroll deductions, compensated absences, and bonuses, as we'll see in a sec. So the first employee-related liability we can deal with is payroll deductions. So payroll deductions just means the government is going to withhold, or your employer will withhold some of your pay to pay for future taxes like Social Security, unemployment, and so on. Since we're pretty limited on time in this class, we're actually going to skip past payroll deductions. Since I'm skipping past it, I won't expect you to know this material. All right, so more generally, if I don't cover something in class, I won't expect you to know it. All right, so we'll skip past payroll deductions. And we'll move on to compensated absences. So a compensated absence, it's just pretty much paid time off. So if you take a sick day and you still get paid, or you take a vacation and you still get paid, you have a compensated absence. Generally, in order for us to accrue a liability for any paid sick days or something like that, 4 conditions have to exist. So the first condition just means that the compensated absence has already been earned. In other words, in order for me to take a sick day, there's not anything else I need to do. Like I've already earned the right to, so pretty much it will be paid to me. The second condition says that the rights need to vest or accumulate. So all that means is a vested right means that the employer is still obligated to pay us for it, even if, for example, we're fired or we're terminated. So the employer is obligated to pay even after employee termination. Right? And an accumulated right, all that means is a right carries forward to future periods, even if we don't use it in the period that we earn the right. Right, so we can only accrue compensated absences if these rights carry forward and they vest. Third condition and the fourth condition are generally no problem. So third condition, payments probable, for the amount can be reasonably estimated. So just for example, if you're paid for like say paid vacation, generally the chance that you wouldn't take paid vacation is really low. So payment of the compensation is probable. And then in terms of reasonable estimation, generally any paid vacation or sick days are based off of your current salary. So generally relatively easy to estimate. All right, so generally these conditions will be met. You don't really have to worry about them too much in the class. I just cover them for completeness. All right, but considering or given that these conditions are met, we're going to recognize an expense and we're going to recognize a liability, obviously, for the compensated absence in the year that it's actually earned by the employees. For this class, we'll use the rate of compensation of the employee in the year that it's earned. However, do realize that under GAAP, we could estimate what their future rate of payment would be, and we could use those instead. Let's run through an example. So let's say Amitron employs 10 individuals and pays each $500 per week. The employees earned 10 unused vacation weeks in 2017, and in 2018, the employees used vacation weeks. All right, but now they each earn $550 per week, and Amitron accrues the accumulated vacation pay on December 31st, 2017 as follows. Okay, so dealing with compensated absences. Again, remember the general guideline here for this, or generally how we account for this is record the transaction in the year earned at the current rate of pay in this class. Okay, so it tells us we employ 10 individuals, we pay each $500 per week. Right, and in total, our 10 employees earned 10 unused vacation days. 10 unused vacation weeks. Right, so if we take those 10 weeks, multiply by 500 per week, we'll get out to $5,000. Right, so it doesn't matter if our employees haven't yet taken the vacation weeks. Right, they've already earned the right to take them, so we have an expense. Right, so in other words, we are saying we'll pay you in the future $5,000 for the work that you've already done now. So we'll debit salaries and wages expense for this $5,000. And our credit here will be to salaries and wages payable, because now we have an obligation to pay them for these vacation weeks when they take them in the future. Right, so we'll credit salaries and wages payable for $5,000. Right, and then in 2018, it says that the employees used vacation weeks. Okay, so in 2018, first off, if they used all the vacation weeks, we can remove the liability or the payable that we created previously. Right, so to remove it, we'll just make a debit to salaries and wages payable for $5,000. Now, when we go to actually pay the employees, we originally recorded the liability at the rate of $500 per week, but when we go to pay them, we're going to pay them using the current rate of compensation. Right, so the amount of cash we'll pay out will just be the 10 weeks times their rate of $550 per week now. Right, so that'll get us to $5,500. Right, and the difference between the cash we paid out and the previous liability we accrued will be our expense in the period. Okay, so we'll debit salaries and wages expense for $500. Okay, and then that'll be our journal entry. So the next employee-related liability we'll deal with is a bonus agreement. So bonus agreement's pretty self-explanatory. We're paying our employees some amount greater than their normal wages or salary. Right, so the way we account for bonuses actually is pretty much just the same thing as regular salaries and wages. So any bonus that we're going to give will debit salaries and wages and expense. And if we haven't yet paid paid the bonus out to our employee, we'll credit salaries and wages payable. If we're paying the bonus at the same time we're recognizing the bonus, then you just credit cash. Okay, so just to do a quick example, Jenkins reports income of $150 for the year of 2017. 10% of its net income will be used to give bonus payments to employees. It'll pay out bonuses on January 15th of the next year. Okay, so since we're paying a bonus and it's 10% of net income, we can take our net income, 150, multiply by 10%. That gets us out to 15,000. Right, as I mentioned, we treat a bonus the same as any regular salaries and wages. So we'll debit salaries and wages expense for 15,000. Right, and in this case, since we're not paying the bonuses at the end of the year, but we'll pay them on January 15th of the next year, we'll credit salaries and wages payable for 15,000. Right, so notice here, same exact journal entry we would make if this were regular salaries and wages. Right, and then for the payment of the bonus, when we go to pay the bonus on January 15th, well, we'll debit salaries and wages payable since we're satisfying our obligation, and we'll just credit cash for 15 grand. Okay, so hopefully that should be pretty straightforward. The last current liability we need to cover is the currently maturing portion of a long-term debt. So just to explain this, let's use an example. So let's just say, for example, we have a $10 million 10-year note, and let's just say it requires us to pay back principal of $1 million every year. So principal are due every year. Okay, so whenever we kind of have like a note like this where installment payments are due, or some portion of the note or bond is due within the next year, whatever is due in the short term will be classified as a current liability. So, for example, at the end of the first year for this note, $1 million will be considered short term, because this will be due within the next year. And the other $9 million, because it's not due within the next year, will be considered long term. Right, so generally we'll go through this process with every long-term debt. Take the currently maturing portion, classify it as a current liability. Now, in certain cases, we wouldn't exclude the portion, or we wouldn't include the portion that matures within the next year as a current liability. Right, and so those cases are given in points 1 through 3 here. So the first one is we retire it with assets that accumulated that have not been shown as current assets. So in other words, we're not using current assets to pay off the currently maturing portion. The second one is we refinance the amount due or retired from the proceeds of a new debt issue. And the third one is conversion into capital stock. So basic idea here is if we go back to the definition of a current liability, right, we said a current liability by definition should be paid off with either a current liability or the creation of another current liability. Sorry, paid off with current asset or the creation of another current liability. So in these three situations here, you're going to notice that essentially we're not paying off the liability with either a current asset or another current liability, so we can't classify that currently maturing portion as current liability because it doesn't meet the definition.